What's going on YouTube? Hope everybody is well, keeping safe during these unprecedented times. It's crazy out there, it really is. But it's been a long time since I've done a video, so it's only right that I share some trading wisdom, some insight, and hopefully you guys can learn something new. More than likely you know this already, but it'll give you a little bit of extra confidence to hold on to your trades for longer. So what I'm going to do in this video is I want to talk about few trades that I took, and you're going to be very surprised when you hear that the techniques I used for these trades were traditional charting, KISS. I used the keeping it simple strategy. So although of course I keep my eye on the volume profile, and of course I keep my eye on the order flow, but as you know, the ladder has been a lot thinner and a lot more volatile than it usually is for the S&P. The S&P reminds me of FTSE 2008, 2009. The S&P reminds me a bit of the DAX the way it's trading now. So but in saying that, the chart patterns have been fantastic, and there are many of them. Obviously, as you know, well, I can't say obviously because I don't know if you know or not, but of course we have the flag patterns, we have the pennants, we have the head and shoulders, we have the double bottom, we have the double top, we have the cup and handle. There are many patterns. In this video I'm going to be talking about the two patterns that I used to generate this capital, and the reason I was able to make this amount of money was because I stuck to the specifications of the strategy, which is the target is determined by the preceding trend. So anyway, let's get into it really quickly. For those of you who are not familiar with the patterns, I've done a fantastic Picasso drawing here. Come on, can we get a round of applause for this? No. So anyway, in this particular scenario, we have the market trending down. It starts to rally up. Now this rally up can be shallow, it can be steep, but we identify it using the channel tool. Then we use I use the Fibonacci extension tool to determine where I'll take my profits, and I do that by starting at the top of the trend, then connecting the tool to the bottom of the trend, and then to the highest point of the retrace. This then gives me my Fibonacci extension levels. After I have these levels, I wait for price to break out of the trend and close outside of the trend, and then I expect the market to go to at least a 61.8 fib. That's where I take my target, but in the majority of cases it will actually go to the 100%. So that's how we trade the flag pattern. That's how I trade the flag pattern. Now on to the head and shoulders pattern. Now another thing with these patterns is that they don't occur too often, so this is why it's important to have other techniques, i.e. volume profile trading, i.e. watching the ladder. But when you do see these patterns, it gives you an opportunity to take a lot more profit out of the market. Alright, so the other pattern is a reversal pattern. So this happens at the bottom of a move. The market has been trending down, it comes to a position, it consolidates and then reverses. It's called a head and shoulders because we have a swing low preceded by another swing low and then a higher swing low, forming two shoulders and a head. In this scenario, we connect the swing highs of the down move. So this swing high connected to that swing line, the lower swing high, using the trend line. Now we enter the position long as soon as price breaks and closes above the trend line, or also known as the neckline. And ideally we also want it to move above this swing high here, because this is obviously potential resistance. As soon as that happens, our stop can be in one of two places. You can either put your stop, this is personal now, you can either put your stop below the line, a few ticks below the line, or you can put it below the most recent swing low. Sometimes there's an additional swing low here or one here, you put it there. Now in terms of target, our target will always be where the move started its aggressive selling. So generally there'll be a long red candle here, and I tend to use the high of that candle or the open. So we expect the market to rally all the way up to here, and that's where we take our profit. So the risk reward on both of these is fantastic, as you can see. Okay, so time to get into the methodology and the logic behind the trades. Obviously the top chart, we've got the 1 minute. The bottom chart is the 5 minute. 5 minute allows me to see the bigger picture. 1 minute allows me to zoom in and see exactly what's taking place. Even if you're looking at the Fibonacci, you can tell that we're at completely different levels at this point. On the 5 minute, we're at the 38.2. The price is testing it. On the 1 minute, we're at the 61.8. You can see that the market had trended down began to retrace up, got to the 50% level, but couldn't break it. Now we're at the 61.8 and price has been rejected and forming a shooting star. What I want to see now is consolidation and price break the low of the trend channel. So let's fast forward and see what happens. All right, perfect. Now looking at the 5-minute chart, first one I want you to identify is we have a doji, which is showing us indecision. Exactly what we want to see just before a reversal takes place. On the 1-minute chart, we have consolidation and we have the candle closing directly on the trend channel. Picture perfect. What I want to see now is the price to continue to trade lower and break that support level, at which point I'm going to enter the market. All right, so let me just continue the recording. All right, no particular action or absorption taking place on the ladder, so this is going to be a straight break of support trade. Market starts moving lower, moves up a bit. Again, you can't really read the volume because there isn't much absorption, but it gets to our level and I'm in at 49.50. First thing I do is put the stop in to quantify my risk, and then I can let the trade run to a certain degree because my target is quite far away from the market. I use the Fibonacci extension tool again as discussed in my explanation earlier. We connect it to the swing high, then to the swing low, and then to the highest point of the retracement, and we get our levels. And coincidentally, the 61.8 coincides with the swing low. Perfect. That's at 26.55, so we'll use 27. So I'll put the stop in, I put the target in at 27, and we're good to go. All right, now let's fast forward and see what happens. All right, so fast forward now. Let me just pause the recording here. So fast forward, you can see how the market has reacted at the various extension levels. Just look at the 38. You can see the green candle lets us know that buyers got involved, but most importantly, buyers respected this particular extension. The 50%, again, buyers respected the extension. So guys, you need to pay attention to this. Now let's see what happens. Market rallies down. You can see the market's acting very differently. It's quite fast and erratic in its movements. And eventually the target is hit and we're out of the trade. Now I'm going to fast forward just to show you what happens when it got to the 100% fib, because I did say it can get to the 100% extension. So let's see what happens when that. And as you can see, in picture perfect fashion, the market or price or buyers, call it what you like, they respected the 100% level and began to buy. They began to take profit. So please take time and practice identifying these patterns and using the extension tool. It will prove to be an invaluable tool in your arsenal, I promise you. Okay, now on to trade number 2. You can see that this is very similar to trade number 1 in terms of the market has trended down, it's consolidating, and we can visually see a flag or a pennant, depending how you want to look at it. We have a continuation pattern. In this occasion, it's been capped by the 38.2% fib, and if you look, you can see it's touched it 1, 2, 3, 4, 5 times, and on the 5th touch we had a strong wick formation, giving us extra confidence that okay, sellers really want to take control of this market. You'll notice a green line. That green line represents the lower the value area and is currently acting as a support. So as the market breaks below the trend line, I also want to see it break below the value area low before getting in. But you'll notice in a minute that I got a bit carried away with the order flow and got in a bit early, and we'll see how that turned out. Looking at the 5-minute chart, you can see we've got a graveyard doji. Always a good signal that the market wants to continue lower. So at this point, my bias is towards the short side. I've got no interest in going long at all. So let's see what happens. All right. Now looking at the ladder, you can see that we've got a bit of accumulation on the offer. 221 contracts are trading through there. 214, 227, I get short at this point, thinking, okay, the market's going to get lower. But something very interesting happens. I'm expecting a blip lower right now, but instead we start having contracts. Let me pause it. We start having contracts accumulating on the bid. We've got 295 now. Let me press play. And now look, we have 313. At this point, this is not what I want to see, because number one, we're at value area low. Number two, we're beginning to have absorption. To me, ordinarily, that's an opportunity to go long. So I get out of the market. Let's see what happens. All right, exit the trade. And hoo-wee. Don't know why I made that noise there. The market rallies up. But the interesting part of this rally is that if you look at the candle that occurred before I entered the trade, the market did not break above it significantly. So I would have still been in that trade had I entered it on a normal trade. But anyway, let's see what happens now. The market's trending down, and on this occasion it cracks the level and I'm short. All right, I'm going to fast forward at various parts of the video just because it's a long-term trade, and I want to try and finish this whole video in under 20 minutes. But all right, so what I do now is identify where I'm going to put my stop above the high of the previous candle, and then my target. Before I put the extension tool on, I just identify any levels where I believe there is support. On this occasion, I've got it around the 65, so I put that in quickly just in case the market blips down, as it has a tendency of doing in these type of volatile markets. So, and then I'll put on my extension tool to see if it coincides. If it doesn't, well, let me just fast forward a little bit here, because initially I put the extension on the wrong chart. So now put my extension again, connecting it to the from the swing high to the swing low, and then to the highest point of the retracement. That's what's different for this extension. So pay attention to that when you're drawing your extensions. Make sure you're connecting it to the highest level. So you'll notice the 61.8 fib is at 59. I've already put a target at 65. So this is giving me a little bit of extra ticks, a few extra pips, whatever you want to call it. Obviously in futures we call it ticks. People who trade forex call it pips. But tomato. What I'm going to do is move my stop lower. They're saying the level is 59. I'll move it to 61.75, any number. To be fair, my risk reward ratio is already fantastic, so yeah, I'm quite happy. I could actually leave it at 65, but because I believe it will go to the 61.8, I'm going to move it down to 61.75. All right, let's see what happens. All right, now I'm going to fast forward a little bit. Yeah, all right, so fast forward, you can see market has trended down pretty much in a straight line. All right, but pay attention now to what happens at the 63 level. Look, we have 223. Now this is, let me pause it right here, okay. At 200 and we have 239 contracts trading through it, and this is why it's important to pay attention to the ladder, because you get to understand how the market reacts. Now that's blatantly absorption. What do you think the market's going to do now? My target is at 61.75. we have absorption at 200 and so we had absorption of 239 at 63. Let's see what happens. Yep, the market rallies. So pay attention to these on your day-to-day, in your normal trades. When you don't see these chart patterns, remember the bread and butter trades can come through order flow. All right, but again, this is a chart pattern trade, so I'm not paying attention to that. The market will always fluctuate. Let's see what happens now. Again, look. All right, and the target is hit. We're out the market. So just pay attention. Let me just pause that again so you can have a look at the chart and see exactly what's taking place. Market trended down. We had consolidation. Market retraced up to, but only up to, should I say, the 38.2% Fibonacci retracement. It then consolidated with lower swing highs. Some people would identify that as a pennant. it then proceeded to break through the trend line and eventually hit our 61.8 Fibonacci extension. So voila, on to the next. Okay, now on to trade number 3. And this trade was based on the principle that previous support becomes resistance. Now, like any trade, we need to see confluence. So I want to see 2 to 3 factors which all coincide to give me additional confirmation that the market should move in the direction that I predict. All right, so the first thing I'm going to do is draw a Fibonacci level. So let me just hit play on the recording so you can see this. And I connect the Fibonacci tool from the swing high to the swing low. And as you can see, almost picture perfect, we have a shooting star forming at the 50% retracement. Can it get any better than that? So not only is the market testing the previous swing low, but we also have a 50% retracement and a shooting star off that 50% retracement. It's almost picture perfect. So also pay attention as well. You might not be able to see it clearly, but at the 38.2% Fibonacci level, we also have the value area low. So we want to see price break below that as well. The confluence is quite a lot in this particular example. So we want to see price break below that, and then we're ready to enter the market. All right, so let's see what happens here. Let me just fast forward a little bit. You haven't got all day. All right, so now price has failed to break above the shooting star, which is excellent for us, gives us additional confirmation. So now we want price to break below. You can see there's a little bit of a support level that's formed just below the low of the value area. So we're going to wait for price to break below there, and then we're going to go short. We're looking at entry around 68.75, 68.20. Okay, so we've missed it, but we put our order in at 68.25 for the blip, and we get blipped in. Now in volatile markets, this tends to happen. So if you miss your entry, always make sure you leave a limit order there. Even when the markets are not too volatile, it tends to retest areas of support and resistance. Okay, so the stop has been placed. Our target is the low, the swing low. Perfect opportunity here. All right, so let's fast forward a little bit after we put on. Let me just put the level in first, then we'll fast forward. Okay, so perfect opportunity for fantastic risk reward. There's no support other than the low of that candle. So yeah, we fast forward a bit, and I just want you to pay attention now to something. Have a look here. Have a look at the previous candle. Notice that it rallied all the way up to our entry price and then sold off. And this is why I don't recommend moving stops to break even. Simply for the fact that many people who miss the opportunity the first time tend to get in on the retrace, which causes market to move much lower. Now, of course, I'm definitely an advocate of moving your stop lower when you're in profit, but you just got to be strategic on where you place it. Okay, let's see what happens. Having a look at the ladder, just observe the price behavior. Okay, we've got a 165 there, but that's not particularly significant. So market trades down. We have 247, 265 on the offer, absorbing in, and it gives me the confidence. I didn't even need the confidence to be fair. I was pretty sure it was going to hit. All right, now on to our fourth and final trade. This one's a little bit different to our previous ones. Our previous trades had been continuation patterns. This one is a reversal and a picture perfect. I've used picture perfect a few times in this video, haven't I? But I'm being honest. This head and shoulders is literally picture perfect on the 1 minute chart. On the 5 minute chart, not so much, but on the 1 minute chart, I mean, you can't really get better than that. We've got our two shoulders and we've got our head, almost looking like the diagram I drew, to be honest. I told you it was a Picasso. All right, so let me just hit play, because the first thing we've got to do is draw in our neckline, and the neckline enables us to see where we're planning to enter the market. So let me just wait for me to do that in the recording. All right, now what we want to see is the candle close outside of that neckline, and also ideally above the previous swing high to go long. So let's see what happens as price approaches it. Now price is initially rejected, sellers get involved and they push the price lower, which is fantastic. We want to see that other traders are respecting the level that we've drawn in. All right, so let's fast forward a little bit because obviously you haven't got all day. The candle closed. You can see that it actually penetrated the trend line but was unable to close above it. Sellers got involved and they pushed the market lower. So I'm just going to fast forward again just to speed things up a little bit. So now on this candle, if you look at the time remaining, we've got 15 seconds remaining, and it looks like the candle may actually close above the trend line. Also, we're also at resistance. We're also at that swing high level. So we want to see price close above there, and then we're ready to go long. And that's exactly what happens. At this point now, I'm just watching the ladder, waiting for my entry. You can see price is broken above. It's come down a little bit of fluctuation, but it begins to stagnate, and I'm prepared to go long. Okay, so I place my limit order at 69 and wait to get filled. Now I'm in the market. The first one I want to do is place my stop as usual. Look at that 107, sorry, 115 at 69.75 gives me the confidence. I remember at that moment feeling pretty happy, you know, because you know you've got it right. You know that other traders are following the same theory that you are. And again, it begins to move rapidly. So we've got to stop in now for our target. As I said, our target is based on where the initial selling began. So I identify that level, but at the same time, there's a low volume node. So I use that for my exit at 81. All right. Now let's fast forward. As you can see, there was a little bit of consolidation. Market eventually broke the high of that consolidation and began to rally. Again, fantastic. Did you see that 78.25 that came in? The level that the amount of volume that came in at 78.25. That is what caused the market to blip so aggressively and get me out of trade. So thank you for watching, guys. I hope you've learned something here, even if it's just patience, even if it is to train your eyes to be able to spot different chart patterns. And remember, these aren't the only chart patterns, but for me, I find that flags work well, head and shoulders work well, double top, double bottoms. But in all instances, you want to see consolidation, because consolidation leads to a build-up of momentum. And when that momentum is when that it's almost like a bottleneck. It's like a bottleneck. It's like shaking a bottle of Coca-Cola. Yeah, that's what I look at consolidation like. It's like a bottle of Coca-Cola that you're shaking, and when you eventually take the lid off, price moves. That's what you want. So hope it's been useful. Stay blessed, stay safe. Until the next time.